The leverage is ridiculous because, again, their job is to basically give the market or give investors a bigger return than what they could get in the S&P 500. And a lot of them have been programmed for the last multiple years that to do that, you got to leverage up because the market always buy the dip, right? Always buy the dip. I do think if Credit Suisse did go into default, I think that would be a big event, right? I mean, we remember Lehman. I don't think we could ever forget Lehman for those of us that traded through that period. And it was a dramatic and traumatic event for the overall investing public as we saw markets collapse. What I'm fascinated by today is that we're actually seeing Credit Suisse up on the day, even in spite of all this kind of chatter over the weekend. Yeah. Now, I know the heads of the company came out and defended it, but I do think all right, so check this out. The combination of this plus, and I know we'll talk about the economic data that we got today, but think about how the Fed may be forced to pivot, and could Credit Suisse be part of the reason that they're going to be forced to pivot? I mean, right now, I'm not looking into it too much, but I do think you have to pay attention to everything right now. I mean, you look at what's gone on with the Federal Reserve, how they've raised interest rates from basically 25 basis points or 0.25% to where we currently are in such a short amount of time. And to me, it was always, and I know I came on a few weeks ago with you, we talked about this. It's silly to me to think that the Fed, how could they not think that there's going to be these ripple effects that are going to cause major issues, right? I mean, it's not like you're going, like Volcker went from 12 to 18%, 50% hike. Here you're going from 0.25% to 3.25%. It's a massive move that's going to rock the system. So again, these type of things, to me, it's going to force them to pivot. It really will. So I think the next Fed meeting is the 2nd and 3rd of November or something like that. So I think that would be where we would start to see it. And I think the Fed will try to be super careful not to make it too obvious. I think you're looking at a 50 basis point hike instead of a 75, which will show that they're on the down slope. But I think, again, what we're seeing is the market's already starting to price this in, which I think is amazing. For instance, 10-year yield is falling today. The stocks market is rallying. So you're already getting the market to kind of jump on this bandwagon. Now, the question is, if we rally too much, does it then kick up the inflation again because of the wealth effect? I mean, it's just like this whack-a-mole type scenario. Yeah, so I do think in terms of sentiment, every move down in the market, especially we just recently pierced those June lows before the bounce today on Friday, we pierced them. I do think it takes its toll on sentiment, and there's absolutely funds that are leveraged to the hilt here. So hedge fund world, it's out there. The leverage is ridiculous because, again, their job is to basically give the market or give investors a bigger return than what they could get in the S&P 500. And a lot of them have been programmed for the last multiple years that to do that, you got to leverage up because the market always buy the dip, right? Always buy the dip. And so I do think you're going to see more and more things. I heard the Vision Fund, I think they're unwinding like 30% of the people in that fund. A lot of funds are already starting to unwind because they've taken such drastic hits. Yes, I would guess it's going to have to be a little bit more dramatic, but I think the dominoes are already in place. It's just, does it happen if Credit Suisse did go under? Is that a domino that would start that chain reaction? And my guess is it would. I mean, something of that nature, but I don't think the kind of the threats right now. And I really do think that the Fed is probably paying very close attention. We know that the central bank in the Bank of England last week was starting to get involved and stuff like that. So these central banks have to be fully aware. I'm sure they're hearing from big hedge fund managers and big leaders out there about, our currency are doing these crazy moves. This isn't healthy. I mean, look at the bond market, insane. And again, if you're in, where do you hide in this market when it's collapsing? Because you can't go to bonds, you can't go to stocks. Crypto's not really doing much. So it's a tough market out there. And I think you get these bear market rallies, but the train tracks have been laid at this point, and I don't think there's much getting away from it. Even a Fed pivot at this point, I think it's a short-term reprieve, and then we have more pain ahead. Yeah, so for me, and number one, you're 100% right on the housing market in terms of interest rates. And I think it's important for investors across the world to pay attention to mortgage rates because that was the wealth effect, right? You talk about COVID and everyone rushing to buy homes. Interest rates were so low. Everything was, you bought a house and then in 6 months it was worth $100,000 more. Right. I mean, so it made people just feel so wealthy where they felt like they could go spend. So for me, it's consumer spending, right? We know the U.S. economy runs on consumer spending. And we have to watch to see, as people run out of money from that they saved during COVID, where does that spending come from, or does it really go to the sidelines? So I think those type of things, the jobs market is going to be super key. We have the jobs report on Friday. I expect it to show a solid slowing in the jobs market, just based on the lagging effect, how we should have already seen it, but because it's lagging, it probably starts to show up. So like things like that are really what I'm looking for. Economic indicators, we saw the ISM today. That really is, you could argue, kick-started the rally that the Fed is going to have to pivot because it did weaken so much. Yeah, it's a good question on the stablecoin side. I mean, for me, I'm still very cautious with the stablecoins after what we saw with Terra Luna. I do worry that some of these stablecoins, there's not enough transparency. And for me as an investor with significant amounts of capital to distribute, it makes me very conservative about putting too much money in any one stablecoin. So, I mean, I think it's worth keeping an eye on. I would mention this, and this is going to the crypto side as well, is that if you saw last week, we saw the stock market really dropping heavily, right, into quarter end. The dollar had at one point been soaring. It started to pull back. But notice how Bitcoin did not have a fall, unlike what it did previously in the previous 6 weeks or month or 2 months, really. And if I could just throw out this concept here, is that I would almost wonder if people in the UK, people in various countries where they're seeing their currency get clobbered by the dollar, potentially had been saying, let me switch some of my assets out of these like pound and into Bitcoin, because our currency is dropping so much, especially with the the Bank of England interjecting there and so forth. So I thought that was very interesting how you kind of saw this divergence where Bitcoin always was going down with the stock market and down when the dollar would go up. All of a sudden, it didn't do that. And it came right as these currencies were getting clobbered. And I do think that is a likely outcome here. And I think this all comes back to the Fed. The Fed's been the leader in hiking rates. I think you see Europe looking to the U.S. and the Federal Reserve and saying, hey, guys, could you slow it down just a little bit, because we're already in a lot of pain. And it's important to recognize that even though you have these different central banks, the Japanese central bank, the U.S., and so forth, everything is so interconnected in this day and age that the Fed can't do what they do and not have an impact on Europe, right? So you have to believe, and hopefully they are talking, and hopefully it's not, I don't think we're at a point where it's every man for themselves, you know how they say it, where it's like the US is like, screw you guys and this and that. I got to believe that they are communicating, and I do think it adds credence to a Fed pivot. And again, the Fed pivot could be something as much as, hey guys, we're going to just do 50, then 25, and then wait 3 months and see where we are. But anything like that would be a positive for the globe, basically. Oh, I would be shocked if we weren't we could already be entering into a recession. But I mean, if you get the unemployment rate to go up to 5 or 6%, then you got to think we're in a recession. And just from the aspect of home prices collapsing back down, I mean, think of all these people that bought homes in the last couple years. And if they start going negative in terms of their value versus what their loan is, I mean, that's a game changer to their mentality, right? Their psychology about, can I go out and buy a new car? What about a new fridge? What about a new TV? All of these things making people pull back and saying, wait a minute. In fact, it's very reminiscent of, obviously, to the extreme of what happened in 07 going into 08 and 09. But yeah, I think we would be in a recession for sure. Oh, I was just going to say, and I mean, just think about buying a car. I mean, over the last 5 years, you could usually get a loan for 0%, right? It was 0%, or at worst case, it was like 1%. And now, I mean, think about all those people that are going in, and they, most people can't buy in cash, especially with car prices. And now they're all of a sudden, having to pay quite a higher interest rate there as well. So it's across the board. And I think, not to poke much fun at the Fed, and it's almost not funny, but I could see us getting into a recession per your last point, and then the Fed will be like, oh, but it's a transitory recession. We'll be out of it in 6 months. And then here we are, we'll be there 3 years later. And I mean, it's funny, but it's not funny, but you guys get my drift there. I think it's going to take a while. I mean, for me, the economic numbers, you'd have them artificially pumped up for so long at this point due to quantitative easing, due to stimulus from the government. So, I mean, think about just keep blowing up a balloon, blowing that up bigger and bigger, and eventually it pops. And in fact, the Fed has popped it by starting to do QT and obviously hiking rates. And so I think the economic numbers it's going to take us a year to bottom out at minimum before we see that. And my big fear, and I think we talked about this last time, is that I'm not sure unless inflation somehow miraculously comes back to 2% or under, I don't see how the Fed will be back to printing us out of that next recession. And so
Yeah.
I actually have projections that could have us in a recession, or at least in a sideways kind of dull kind of environment for years to come.